Shares in luxury goods firms are losing steam. LVMH stock fell 4.25% on Wednesday, despite the company reporting a 10% increase in third-quarter sales. It's best known for its Louis Vuitton brand, but also sells cosmetics through Sephora and liquor under the Hennessy umbrella. The negative sentiment spread across the industry. Gucci owner Kering, Francis Hermes, and Britain's Burberry were also in the red. Investors are worried China's big spenders will shop less because of the trade war with the US. The IMF says ongoing trade tensions will lead to a slowdown in the world's second-largest economy. And analysts say Chinese consumers are losing purchasing power because of a weaker currency. The Chinese yuan is down 5% against the US dollar this year. Last year, people in China bought $22 billion worth of luxury goods, up 20% from 2016. And that doesn't include Chinese tourists who shopped overseas. But with trade tensions growing, shoppers might soon be putting more of their orders on hold.
Well, for more on the story, we're joined by luxury industry researcher Sebastian Huber from the Lucerne University of Applied Sciences and Arts. Thank you so much for your time. Firstly, we did see quite a significant sell-off today among luxury stocks. Do investors have good reason to be concerned about a slowdown in sales, particularly in one of the biggest markets, China?
Yes, of course. As you just said in your report, uncertainty is always a challenge for the luxury market. And there is sort of a lump risk in China. The Chinese consume as much at home as they consume overseas. So obviously, with some uncertainty on the Chinese market, the industry as a total is certainly going to be affected. On the other side, I would say the industry is also known for being used to very strong growth over long periods of time. So I would say investors' expectations are very high on the brands and the groups that you just mentioned, such as LVMH Group and Hermes and others.
Now, the sell-off that we saw today was in part due to a report released by Morgan Stanley, which downgraded the luxury goods sector to underweight, saying that shares look stretched and that Chinese consumer confidence appears to have peaked. Is Morgan Stanley right in their analysis?
Well, I think a number of factors are at play. The Chinese consumer is definitely shifting. We see a new consumer coming up, a younger clientele that shops differently for luxury. And with a big share of the global market, also in markets outside mainland China, there is obviously concern that the big groups can meet up with those new consumers and their demands, which differ from the status symbols that they're used to be buying in the past. So obviously, I would say yes, a concern is quite right. I wouldn't see it as dramatic. I could see in a short-term future maybe some concerns focused on the trade disputes and the Brexit and other economics that might influence the market quite a bit. On the long term, I believe there's always a reason for luxury. I think the groups are in a strong position to regain their stakes. And Bain & Company, a research group on luxury, already a year ago predicted what they call a new normal, which is basically no longer these impressive growth rates that we had in the past, but more what we are used in other industries. And that is, from an investor's point of view, something they have yet to get used for the luxury brands.
You mentioned the changing nature of the clientele of some of these luxury brands, moving away from the likes of wealthy housewives to those of the up-and-coming millennials. So how can luxury brands adapt to that changing clientele?
Well, I believe their shopping behavior is different. They expect different service components from a brand. It goes beyond, as I said, the status symbol with a logo. They want to understand where the brand is coming from, what makes it different from other brands. They want to buy into the story. They want also the brands to open up to them and not look down onto the customer by saying this is a product, you take it or leave it. But They want to customize their product, they want to customize their experience, they want to be in touch with the brand over all kinds of communication channels. These are all things other industries have witnessed in the past. We've witnessed particularly that the Chinese market has its own dynamics with an own ecosystem of apps and online platforms second to none and not comparable to other markets in the world. So these predominantly European or American brands need to understand the Chinese market, need to attune to these tools, these channels, the interactions that customers expect, new retail environments as well, which are definitely needed to entice those customers. And we see actually many brands going that way already. So in general, on the long run, I'm actually quite positive that the industry will rebound.
Okay, Sebastian Huber, we will have to leave it there, but thank you so much again for your time.